There is a chart the Federal Reserve publishes every month. It sits in plain sight, accessible to anyone with an internet connection. Most people will never look at it. Those who do will not understand what they are seeing. But there are those who know how to read it. And what they see in that chart, right now, is a pattern that has appeared only once before in the last century. It appeared in the summer of 1929. Within weeks, the greatest financial collapse in modern history began. $14 billion in market value, the equivalent of hundreds of billions today, vanished in a matter of days. Fortunes built over generations were erased in hours. And it all started with a divergence. A quiet, technical divergence that the public never saw coming. That divergence has returned. They will tell you the economy is strong. They will show you record corporate profits and all-time highs in the major indexes. They will use words like resilience and soft landing and new paradigm. But while they tell you this, central banks around the world are buying physical gold at a pace not seen since they abandoned the gold standard. While they tell you to stay invested, corporate insiders, the CEOs, and board members of the very companies you are being told to buy are selling their own stock at the fastest rate in more than a decade. This is not a vote of confidence. This is an exit. And if you know where to look, you can see exactly what they see. You can see the pattern. And once you see it, you cannot unsee it. By the end of this documentary, you will not only understand what the 1929 divergence was and why it mattered, you will see it overlaid on today's market data. You will understand the precise mechanism by which this imbalance resolves itself. Not gradually, not gently, but violently. You will see the timeline we are on, the stages that are unfolding, and the wealth transfer that is already in motion. This is not speculation. This is not fear-mongering. This is pattern recognition. And the pattern has been triggered. Markets are not random. They feel random to those who do not understand them, but beneath the noise of daily price movements, beneath the headlines and the emotions and the talking heads, there are structures. There are patterns. And some of these patterns are so rare, so historically significant, that when they appear, they demand attention. Not because they are popular, not because they are easy to understand, but because they have never been wrong. Technical analysis, for most people, is a collection of lines and indicators and oscillators that seem to contradict each other as often as they agree, and for most patterns, that skepticism is warranted. But there are patterns that exist on a different level. Patterns that do not emerge from sentiment or speculation, but from the structural mechanics of the financial system itself. Patterns that reflect the relationship between speculation and the real economy, between leverage and solvency, between euphoria and mathematics. The divergence pattern is one of these. A divergence occurs when two things that should move together stop moving together. In the human body, it would be like your heart rate spiking while your blood pressure crashes, a sign that something fundamental is breaking down. In the financial system, divergence occurs when speculative indexes continue to rise, while the indexes that measure the real economy, production, transportation, small business health, begin to falter. It means the market is no longer pricing in reality. It is pricing in hope. And hope, when it is built on leverage, does not end quietly. Most divergences are minor. They correct within weeks or months, and life goes on. But there is one type of divergence that is different, one that has appeared only a handful of times in the last 100 years. And every time it has appeared at this magnitude, it has preceded a collapse, not a correction, not a bear market, a collapse. The reason this pattern matters is not mystical, it is mathematical. When speculation decouples from the real economy, it means that valuations are being held up not by earnings, not by productivity, not by genuine growth, but by leverage, by borrowed money, by margin debt and derivatives, and the belief that prices will keep rising simply because they have been rising. And leverage, by its nature, is unstable. It amplifies gains on the way up, but it amplifies losses on the way down. And when the real economy begins to contract while speculation continues to expand, the gap between the two becomes a coiled spring. The wider the gap, the more violent the snapback. In the summer of 1929, that gap opened, and those who understood what they were looking at quietly stepped aside. What came next would redefine an entire generation's understanding of risk. To understand what is happening now, you must first understand what happened then. The 1,920 seconds were a time of unprecedented optimism. The First World War had ended. American industry was booming. New technologies, radio, automobiles, electrification were transforming daily life in ways that seemed almost magical. Credit was easy, speculation was rampant, and the stock market, for nearly a decade, had done nothing but go up. By 1929, Millions of Americans who had never invested before were borrowing money to buy stocks, convinced that the boom would last forever. Newspapers printed stories of secretaries and shoeshine boys making fortunes. Economists declared that the business cycle had been conquered. It was, in every sense, a new era. But there was a theory, a framework for understanding market health that had been developed decades earlier by a man named Charles Dow. Dow, the founder of the Wall Street Journal and creator of the Dow Jones Industrial Average, had observed something crucial about the nature of economic growth. He noticed that for a bull market to be genuine for rising stock prices to reflect real economic expansion, two things had to happen in tandem. Industrial production had to increase, and transportation had to increase, because you cannot have a growing economy if factories are producing goods that are not being shipped. You cannot have sustainable growth if the companies making products are thriving while the companies moving those products are struggling. The two must confirm each other. This became known as Dow theory, and for decades, it worked. When both the industrial average and the transportation average made new highs together, it signaled genuine economic strength. But when one made new highs and the other did not, it was a warning. It meant something was broken beneath the surface. In the summer of 1929, the Dow Jones Industrial Average was making new all-time highs nearly every week. The public was euphoric. But the Dow Jones Transportation Average, the index tracking the railroads that moved goods across the country, had stopped rising. In fact, it had begun to roll over. The industrials were screaming strength. The transports were whispering weakness. This was the divergence. And it meant that while speculation was soaring, the real economy, the actual movement of goods, the tangible evidence of commerce was already contracting. The smart money saw it. The architects of the system, the men who understood leverage and liquidity and the mechanics of margin, saw it. They did not announce it. They did not warn the public. They quietly sold their positions, distributing their shares to the euphoric masses who were convinced that this time was different, that the boom would never end. This is what always happens at the top of a bubble. The professionals sell to the amateurs, the insiders sell to the outsiders, and by the time the divergence becomes obvious to everyone, it is too late. On September 3rd, 1929, the Dow Jones Industrial Average reached its peak. For the next 6 weeks, it drifted lower, but the decline was slow, orderly. Many believed it was just a healthy pullback, a chance to buy the dip. Then, in late October, the deleveraging began. October 24th, 1929. Black Thursday. The market opened lower and continued to fall throughout the morning. By midday, panic had set in. Orders to sell were flooding the exchanges faster than they could be processed. Crowds gathered outside the New York Stock Exchange, watching in stunned silence as fortunes evaporated. A consortium of bankers, led by J.P. Morgan, attempted to stabilize the market by purchasing large blocks of stock. It worked. Briefly, the market recovered some of its losses. The newspapers the next day reassured the public that the worst was over, that confidence had been restored. They were wrong. The following Tuesday, October 29th, the real collapse began. More than 16 million shares traded hands, a record that would stand for decades. Prices fell so fast that the ticker tape, the machine that printed stock prices, fell hours behind. Investors had no idea what their holdings were worth. They only knew they were losing. Margin calls went out across the country. These were the demands from brokers for investors to either deposit more cash or sell their stocks to cover their loans. But there was no more cash. And when everyone tries to sell at the same time, there are no buyers. Prices went into free fall. By mid-November, the Dow had lost nearly half its value. But that was just the beginning. The deleveraging continued for 3 years. By the time it reached its bottom in 1932, the Dow Jones Industrial Average had fallen 89% from its peak. 89%. Entire fortunes, built over lifetimes, were gone. Banks failed by the thousands. Unemployment reached 25%. Breadlines stretched for blocks. The optimism of the Roaring Twenties gave way to the despair of the Great Depression. And it all started with a divergence. A technical signal that most people did not understand and did not see. But the mathematics of that divergence were absolute. When speculation is built on leverage, and the real economy cannot support that leverage, the system does not correct gently. It collapses, because leverage is not neutral. Leverage is an accelerant. It turns a 10% decline into a total wipeout. It forces selling that triggers more selling in a feedback loop that cannot be stopped until the leverage is purged from the system. This is not theory. This is mechanical. This is what happens when the gap between speculation and reality becomes too wide. The divergence does not fade away. It resolves. and it resolves violently. For 95 years, that pattern did not return at this magnitude. The system came close a few times in the late 990 seconds in 2008, but the divergence was never as extreme, the echo never as clear, until now. Pull up a chart of the NASDAQ 100. This is the index that tracks the largest non-financial companies in America, dominated by technology giants Apple, Microsoft, Nvidia, Amazon, Tesla. Over the past 2 years, this index has gone virtually straight up. It has made new all-time highs repeatedly, driven by euphoria around artificial intelligence, around the belief that a new technological revolution is underway. The gains have been staggering. Trillions of dollars in market capitalization have been added. The media calls it the dawn of a new era. Now pull up a chart of the Dow Jones Transportation Average. This is the modern equivalent of the index that failed to confirm the highs in 1929. It tracks the companies that move goods, airlines, railroads, trucking companies, logistics. These are the businesses that serve as the circulatory system of the real economy. If goods are being produced and consumed, these companies thrive. If the economy is genuinely strong, they make new highs alongside the speculative indexes. They are not making new highs. In fact, they have been declining. The divergence is not subtle. It is glaring. Now add the Russell 2000 to your screen. This index tracks 2,000 small to mid-sized American companies, the businesses that employ the majority of American workers, that serve local markets, that are sensitive to the real conditions on the ground. These companies do not benefit from global supply chains or stock buybacks funded by cheap debt. They live and die by genuine economic demand. If the economy is truly strong, they participate in the rally. They are not participating. The Russell 2000 has drastically underperformed the NASDAQ 100. While the mega-cap technology stocks have soared, the average American business has been treading water or worse. This is the 1,929 pattern. This is the divergence, and it is not similar to 1,929. It is statistically identical to 1,929. But the data goes deeper. The Federal Reserve tracks margin debt, the amount of money investors are borrowing to buy stocks. Right now, margin debt relative to GDP is at levels that have only been seen twice before, in 1929 and in 2000, just before the dot-com crash, the Shiller-Cape ratio, which measures stock market valuation against 10 years of averaged earnings, currently sits at a level that has only been exceeded twice in history, once in 1929, once in 1999, at the peak of the dot-com bubble. Both times, the market subsequently collapsed by more than 80% in real terms. The pattern is not hidden. The data is public. The Federal Reserve publishes it. The question is not whether the divergence exists. The question is why no one is talking about it. The answer lies in understanding what is actually driving the market. If you look only at the headline indexes, the S&P 500, the NASDAQ 100, you see record highs, and you might conclude that the market is healthy. But those indexes are market cap weighted, which means the largest companies have the most influence. Right now, 7 companies, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla, account for nearly all of the gains in the S&P 500 over the past 2 years. 7 companies, remove them, and the average stock is flat or down. The median stock is already in a bear market. But because those 7 companies are so large, they pull the entire index higher, creating the illusion of broad-based strength. This is concentration risk at a level that has never existed before. In 1929, at least the rally was spread across multiple sectors: utilities, industrials, consumer goods. Today, the entire market is being held up by a handful of technology stocks, all of which are valued on the assumption that future earnings will justify current prices. But the real economy, the transportation companies, the small businesses, the regional banks, is already showing cracks. And then there is the leverage. In 1929, the primary form of leverage was brokers' loans, money borrowed to buy stocks. Today, the leverage is far more complex and far more dangerous. It exists in derivatives, in exchange-traded funds that promise to deliver double or triple the returns of an index, in algorithmic trading strategies that amplify volatility, in corporate debt that has been used not to invest in growth, but to buy back stock and inflate share prices. The notional value of the global derivatives market is estimated to be over $1 quadrillion, more than 10 times the size of the entire global economy. When the deleveraging begins, it will not unfold over months, as it did in 1929. It will unfold over days, perhaps hours. The divergence is here. The leverage is in place. The precedent is clear. The only question that remains is, what will trigger it? Divergences do not resolve themselves on a schedule. They can persist for weeks, even months, creating what traders call a melt-up, a final parabolic surge in prices that draws in the last wave of buyers, the final skeptics who capitulate and decide that maybe this time it really is different. This is not a flaw in the pattern. It is part of the pattern. The longer the divergence persists, the more extreme the speculation becomes, and the more violent the eventual correction. The trigger will come from the real economy. It always does. In 1929, the trigger was the realization that corporate earnings were not going to support stock valuations. In 2008, it was the collapse of subprime mortgages. In 2025, the trigger will likely come from one of several vulnerabilities that are already visible. Commercial real estate is collapsing. Office buildings in major cities are sitting vacant, unable to generate the rental income needed to service their debt. Regional banks, which hold much of that commercial real estate debt, are already under stress. Several failed in 2023, and the only thing that stopped a broader panic was emergency intervention by the Federal Reserve. But that intervention did not solve the problem. It delayed it. Another vulnerability is the sheer scale of government debt. The United States is adding trillions of dollars to its national debt every year, and the interest payments on that debt are now consuming a larger share of the federal budget than defense spending. At some point, the bond market will lose confidence in the government's ability to service that debt without inflating the currency. When that happens, interest rates will spike, and the entire structure of asset valuations, which are based on the assumption of low rates, will collapse. Or the trigger could be geopolitical, a conflict that disrupts global supply chains, an oil shock, a cyber attack on financial infrastructure. It does not matter what the specific trigger is. What matters is that the system is primed. The divergence has created an instability, and all it takes is one shock to set off the cascade. Here is how it will unfold. The initial event will cause a sharp decline, 10, maybe 15% in a matter of days. The media will call it a correction, a healthy pullback. They will tell you to buy the dip, that this is an opportunity, and some people will. But that initial decline will trigger margin calls. Investors who have borrowed money to buy stocks will be forced to either deposit more cash or sell their positions. Most will not have more cash, so they will sell. And their selling will push prices lower, which will trigger more margin calls, which will force more selling. This is the margin call cascade. It is a feedback loop, and once it begins, it is extraordinarily difficult to stop. In 1929, it took days to unfold because trading was manual, because information moved slowly. Today, with algorithmic trading and high-frequency systems, the cascade will happen faster. Sell orders will flood the market at a pace that overwhelms the system. Liquidity, the ability to find a buyer for your shares, will vanish. Bid-ask spreads will widen to absurd levels. You will try to sell, and the price you get will be far below the last quoted price. At some point, the exchanges will halt trading. They will call it a technical glitch, a circuit breaker designed to prevent panic. But the halt will not calm the panic. It will amplify it. Because when trading is halted and you cannot sell, you are trapped. And the fear of being trapped is more powerful than the fear of losing money. When trading resumes, the selling will be even more intense. The Federal Reserve will intervene. They will announce emergency measures, liquidity injections, interest rate cuts, perhaps even direct purchases of stocks, as the Bank of Japan has done. And for a moment, it might seem like it is working. Prices might stabilize, even rally. But the rally will not last, because the problem is not a lack of liquidity. The problem is insolvency. The problem is that assets are overvalued, that earnings cannot support the debt, that the real economy is already contracting. You cannot solve insolvency with liquidity. All you can do is delay the recognition of the problem, and then the deleveraging will begin in earnest. Not just in stocks, but in all asset classes. Real estate, bonds, commodities, everything will be sold to raise cash, to meet margin calls, to cover losses. The correlation between assets will go to 1, meaning everything will fall together. Diversification, the principle that investors have been told protects them, will fail, because in a deleveraging event, there is only one safe asset, cash. And even cash will be suspect, because central banks will be printing money at an unprecedented rate to try to contain the crisis. This is not speculation. This is what happened in 1929. This is what happened in 2008. And the mathematics of leverage dictate that it will happen again, only faster and more severe, because the scale of the leverage is exponentially larger. In 1929, the Dow fell 89% over 3 years. In 2025, the decline could reach 80% or more in 18 months. Not because the companies will all go bankrupt, but because the valuations will be repriced to reflect reality rather than speculation. And in that repricing, Trillions of dollars in wealth will simply cease to exist. There is a data point that rarely makes headlines, but it is one of the most telling indicators of what is actually happening beneath the surface of market euphoria. It is called insider selling. Corporate insiders, CEOs, CFOs, board members, are required by law to report when they buy or sell shares of their own company. And right now, they are selling at the fastest pace in more than a decade. Think about what that means. These are the people who know their companies better than anyone. They see the earnings reports before the public does. They know the growth projections, the risks, the challenges. If they believed their own stock was undervalued, if they believed the rally had further to run, they would be buying. But they are not buying, they are selling. And they are not selling a little. They are selling aggressively. Some will argue that insiders always sell near the top, that this is normal profit taking, and to some extent, that is true. But the ratio of insider selling to insider buying is now at an extreme that has only been seen a handful of times in the past 50 years. Each time it reached this level, a major decline followed within 6 to 12 months. The insiders are not making a statement. They are not trying to send a message. They are simply acting on what they know. And what they know is that the risk-reward at current valuations does not favor holding. But the insiders are not the only ones quietly exiting. Central banks around the world have been buying gold at a pace not seen since the 1,970 seconds when the gold standard was abandoned. In 2022 and 2023, central banks purchased over 1,000 tons of physical gold each year, removing it from the market and adding it to their reserves. China has been the most aggressive, but Poland, India, Turkey, and other nations have joined the buying spree. Why? Why would central banks, the institutions that control fiat currency, be stockpiling a metal that has no yield, that pays no dividend, that produces nothing? Because they understand what is coming. Gold is not an investment. It is insurance. It is the asset you hold when you lose faith in the system, when you believe that currencies will be debased, that bonds will default, that the financial architecture itself is at risk. Central banks are not buying gold because they think the price will go up. They are buying gold because they do not trust the system they themselves manage. And then there are the billionaires. Over the past 3 years, there has been a quiet but unmistakable shift in how the ultra-wealthy are positioning their capital. Bill Gates has become the largest owner of farmland in the United States. Jeff Bezos has been selling billions of dollars in Amazon stock. Warren Buffett, the man who famously advised investors to buy and hold, has been sitting on the largest cash position in Berkshire Hathaway's history, unable or unwilling to find attractive investments at current valuations. Other billionaires have been acquiring private infrastructure, water rights, energy assets, supply chain logistics. This is the playbook. This is what always happens before a reset. The public is told to stay invested, to buy the dip, to believe in the long-term story. Meanwhile, those who understand the system are quietly converting paper assets into hard assets, into things that have intrinsic value that cannot be inflated away or legislated out of existence. The divergence between what they are saying and what they are doing is as wide as the divergence in the market itself. And just like the market divergence, it will resolve. But by the time the public realizes what has happened, the transfer will be complete. Every major financial collapse in history has been accompanied by a wealth transfer. The 1929 crash was not just a destruction of wealth, it was a redistribution of wealth. Those who saw it coming, who sold their stocks and held cash or gold, were able to buy assets for pennies on the dollar in the aftermath. Entire estates, businesses, and properties changed hands. The wealthy became wealthier. The middle class was wiped out. The same pattern played out in 2008. The housing crash destroyed the net worth of millions of American families. But private equity firms and hedge funds, armed with cheap credit from the Federal Reserve, swooped in and bought distressed properties in bulk. Today, institutional investors own a significant percentage of single-family homes in America, converting what was once the foundation of middle-class wealth into a rental income stream for the ultra-wealthy. This is not opportunism. This is design. The system is structured to facilitate these transfers. During periods of euphoria, the public is encouraged to buy at inflated prices. Commercials tell you to invest for your future. Financial advisors tell you that timing the market is impossible, that you should stay invested through volatility, and for most of the time, that advice works. But it fails catastrophically during deleveraging events, because deleveraging events do not follow normal distributions. They are not minor corrections. They are total resets. And when the reset happens, those who are holding overvalued paper assets, stocks, bonds, ETFs, lose everything. But those who position themselves in cash, gold, or hard assets before the collapse are able to acquire real wealth at a fraction of its previous cost. This is the great taking, and it is happening right now. The public is being told that stocks are the only way to stay ahead of inflation, that cash is trash, that missing the rally is the biggest risk. Meanwhile, insiders are selling. Central banks are buying gold. Billionaires are acquiring farmland. The message and the action are completely opposed. And when there is a divergence between what the architects of the system are saying and what they are doing, you should pay attention to what they are doing. But the transfer will not stop at asset prices. The next phase, the phase that is already being prepared, involves the architecture of money itself. Central bank digital currencies, CBDCs, are being developed by governments around the world. These are not cryptocurrencies. They are digital versions of fiat currency, fully controlled by central banks, programmable and traceable. The justification for their introduction will be the chaos of the next financial crisis. When the banking system is in turmoil, when people have lost faith in traditional banks, governments will offer a solution: a new, secure, digital currency backed by the central bank. But CBDCs are not about security. They are about control. A programmable currency can be restricted. It can be set to expire, forcing you to spend it rather than save it. It can be geofenced, preventing you from using it in certain places or for certain purchases. It can be monitored in real time, eliminating financial privacy, and it can be turned off. If you are deemed a risk, if you dissent from the narrative, your access to your own money can be revoked. This is not conspiracy. The technology exists. The pilot programs are already underway, and the crisis that will justify their widespread adoption is approaching. The collapse will be used not just to transfer wealth, but to fundamentally alter the relationship between individuals and the financial system. You will own nothing, as the saying goes, and they will tell you it is for your own good. Patterns do not unfold randomly. They follow sequences. The 1929 crash did not happen overnight. It unfolded in stages, each one building on the last, each one pulling more participants into the deleveraging. If the pattern is repeating, and all the data suggests that it is, then we are not watching a possibility, we are watching a timeline. Stage 1, the final euphoria. This is the stage we are in now. The market continues to make new highs, driven by a handful of mega-cap stocks. The media proclaims a new era. Artificial intelligence is presented as a technology so transformative that traditional valuation metrics no longer apply. Retail investors, many of whom sat out the early stages of the rally, finally capitulate and pour money into the market, unwilling to miss out any longer. This is the distribution phase. The smart money, the insiders, are selling into this euphoria, quietly exiting their positions while the public is buying. The divergence during this stage widens to its maximum extent. The Nasdaq continues to scream higher while the transportation average and the Russell 2000 lag further and further behind. Margin debt reaches new records. The Shiller-Cape ratio pushes into territory that has only been seen twice before. The economic data from the real economy, manufacturing, shipping, small business sentiment, continues to deteriorate, but it is ignored because the headline indexes are rising. The longer this stage lasts, the more violent the resolution will be. Based on historical patterns, this stage likely lasts through the first quarter of 2025, possibly into early Q2. Stage 2, the event. This is when the deleveraging begins. Something breaks. It could be a commercial real estate default that cascades through the regional banking system. It could be a geopolitical shock that disrupts supply chains and sends oil prices spiking. It could be a sudden spike in bond yields as the market loses confidence in the government's ability to service its debt. The specific trigger does not matter. What matters is that the system is so over-leveraged, so fragile, that any shock is sufficient to start the cascade. The initial decline is sharp 20 to 30% in a matter of weeks. The media calls it a correction. They tell you it is healthy, that the market needed to cool off. Some investors, conditioned by years of buying the dip, see this as an opportunity and deploy more capital. But this time, the dip does not bounce. Instead, the margin calls begin. Automated selling accelerates. Liquidity evaporates. The exchanges halt trading, citing technical issues or circuit breakers. When trading resumes, the selling intensifies because the halts have created fear and trapped positions. The Federal Reserve responds with emergency measures, interest rate cuts, liquidity injections, perhaps even direct interventions in the stock market. For a brief moment, these measures seem to work. Prices stabilize, there is a relief rally. The media declares that the worst is over, that the Fed has once again saved the market. But the rally is a trap. It is the last chance for those who understand what is happening to exit. Within weeks, the decline resumes, and this time, There is no floor. Based on the 1929 timeline, Stage 2 likely unfolds between Q2 and Q3 of 2025. Stage 3, the long deleveraging. This is the phase that breaks the psyche. The initial crash was shocking, but it was fast. Stage 3 is slow, grinding, relentless. Month after month, the market continues to decline. Every rally is sold. Every piece of good news is met with skepticism. The problem is no longer panic. The problem is insolvency. Companies that looked strong on paper are revealed to have been surviving on cheap debt that they can no longer service. Banks that pass stress tests are exposed as holding assets that are worth far less than their stated value. Pension funds, insurance companies, sovereign wealth funds, all of them are forced to recognize losses that they can no longer hide. The real economy begins to reflect the market collapse. Unemployment rises, consumer spending contracts, tax revenues fall, forcing governments to either cut spending or print money to cover deficits. Inflation and deflation war with each other in different sectors, asset prices collapse, while the cost of essentials rises due to supply chain disruptions and currency debasement. This is stagflation, the nightmare scenario that central banks insist is impossible. During this phase, the wealth transfer accelerates. Assets are sold at liquidation prices. Those who have cash or hard assets are able to acquire real wealth, real estate, businesses, infrastructure, for a fraction of what they cost at the peak. The public, meanwhile, is financially and emotionally devastated. Retirement accounts have been cut in half or worse. Home values have collapsed. The trust in the system, already fragile, disintegrates entirely. And it is during this phase that the solutions are introduced. Central bank digital currencies are rolled out as a way to stabilize the financial system. Governments propose new regulations, new oversight, new structures that promise to prevent this from ever happening again. But these solutions do not restore what was lost. They consolidate control. They ensure that the next cycle will be even more centralized, even more monitored, even more difficult to escape. Based on the 1929 pattern where the Dow fell 89% over 3 years, Stage 3 could last from late 2025 through 2027, possibly longer. The total decline, measured in real terms, adjusted for currency debasement, could reach 80% or more. This is not a prediction. This is what the pattern suggests. This is what the mathematics of deleveraging dictate. Why is no one talking about this? The data is public. The Federal Reserve publishes the margin debt figures. The Shiller-Cape ratio is freely available. The divergence between the NASDAQ and the transports is visible on any financial website. The insider selling data is reported by law. The central bank gold purchases are documented by the World Gold Council. None of this is hidden. None of this requires special access or insider knowledge. It is all there, in plain sight, for anyone willing to look. And yet, if you turn on the financial news, if you read the mainstream investment publications, you will hear nothing about the 1929 pattern. You will hear about the strength of the labor market, about the resilience of the consumer, about the transformative potential of artificial intelligence. You will be told that valuations, while elevated, are justified by future growth. You will be told that the Federal Reserve has the tools to manage any downturn, that a soft landing is not only possible but probable. You will be told to stay invested, to ignore the noise, to trust the process. Why? Because the system depends on your participation. The market is not a neutral mechanism that discovers the true value of assets. It is a structure that requires constant inflows of capital to sustain itself. When individual investors buy stocks, they provide the liquidity that allows institutions and insiders to sell. When pension funds and 401(x) allocate capital to equities, they create the demand that supports elevated valuations. The system is designed to encourage you to buy and hold, to believe in the long term, to ignore short-term volatility. And for most of the time, that strategy works. But it fails catastrophically during deleveraging events. The people who manage the system, the central bankers, the policymakers, the heads of major financial institutions understand this. They understand that if the public loses confidence, if investors begin to sell en masse, the deleveraging accelerates and becomes uncontrollable. So they do everything they can to maintain confidence. They manipulate short-term interest rates to keep borrowing cheap. They intervene in bond markets to suppress yields. They use language carefully, always projecting optimism, always suggesting that any problems are temporary and manageable. But while they tell you to stay calm, they are acting very differently. Central banks are buying gold. Insiders are selling stock. Billionaires are moving into hard assets. The divergence between their words and their actions is as wide as the divergence in the market data. And just like the market divergence, it will resolve. But by the time it becomes obvious to everyone, the opportunity to act will have passed. If this pattern has only appeared once before at this magnitude, and it led to the greatest financial collapse in modern history, why is no one sounding the alarm? Because those who understand it are not trying to warn you. They are positioning themselves. They are on the other side of the trade. And when the deleveraging begins, they will be the ones buying the assets you are forced to sell. This is not cynicism. This is pattern recognition. This is understanding that financial markets are not egalitarian systems designed to create broad-based prosperity. They are mechanisms for transferring wealth from those who do not understand the patterns to those who do. You are faced with a choice. You can dismiss what you have seen here as alarmism, as doom rhetoric, as just another prediction that will fail to materialize. And perhaps you would be right to be skeptical. The history of financial forecasting is littered with false alarms, with people who predicted crashes that never came, who stayed on the sidelines while the market continued to rise. Skepticism is rational. Caution is warranted. But consider the alternative. Consider the cost of being wrong. If you dismiss this pattern and it turns out to be correct, you will watch 80% or more of your portfolio evaporate. You will see your retirement pushed back by a decade or more. You will experience the same devastation that millions experienced in 1929, in 2000, in 2008, and you will realize, too late, that the warning signs were there, that the data was public, that the pattern was visible. On the other hand, if you take this seriously and the collapse does not materialize, what have you lost? The opportunity cost of gains you did not capture, the discomfort of acting against the crowd, the social pressure of being the person who exited early. These are real costs. But they are not permanent. Capital can be redeployed. Opportunities return. The asymmetry of risk in this moment is extreme. The potential loss from ignoring the pattern far exceeds the potential loss from taking it seriously, and that asymmetry is itself a signal. When the stakes are so one-sided, when the historical precedent is so clear, caution is not irrational. Caution is rational. Ignoring the pattern is the gamble. But acting on this information is difficult. It requires going against the momentum of the market. It requires ignoring the advice of the financial establishment. It requires accepting that you might look foolish in the short term. Human psychology is not wired for this. We are social creatures, and going against the crowd feels wrong, even when the data supports it. In 1929, those who saw the divergence and sold were mocked for months as the market continued to rise into September. They endured the ridicule, and then they survived. The pattern does not care about your comfort. It does not care about your beliefs or your hopes. It is mathematical. It is structural, and it has never been wrong. The divergence has triggered. The timeline has begun. The insiders have positioned themselves. The public is still buying. And somewhere in the next 12 to 18 months, the leverage will reach a point where it can no longer be sustained, and the deleveraging will begin. You cannot stop it, you cannot change it, but you can prepare for it. In the weeks before Black Tuesday, the divergence was visible to anyone who knew where to look. The industrials were making new highs, the transports were rolling over, the smart money was selling, and the public was buying, convinced that the boom would last forever. There were people who saw it. Investors who understood Dow theory, who recognized that the real economy was already contracting while speculation continued to soar. They sold, they moved to cash, they stepped aside, and when the collapse came, they were not caught in it. They were able to watch from the safety of the sidelines as fortunes were destroyed. And then, in the aftermath, they were able to buy real assets at liquidation prices. But they were the minority. The vast majority did not see it, or they saw it and dismissed it, or they saw it and believed that this time was different, that the new technologies of the era, radio, automobiles, electrification, had fundamentally changed the rules of economics. They believed that the Federal Reserve, established just 16 years earlier, had the tools to prevent any serious downturn. They believed the assurances of the bankers and the politicians who told them the economy was fundamentally sound. And then, in a span of weeks, everything they believed was proven wrong. The market did not correct gently, it collapsed. The diversification they thought protected them failed because everything fell together. The Federal Reserve, far from preventing the disaster, was powerless to stop it. And the wealth they had accumulated over years or decades vanished in days. 95 years later, the pattern has returned. The divergence is here. The leverage is extreme. The insiders are selling. The central banks are buying gold. And the public is being told to stay invested, to buy the dip, to believe in the long term. History does not repeat, but it echoes. And right now, if you listen closely enough, you can hear 1,929 calling from across nearly a century. The chart is there. The data is public. The pattern has never lied. In 1929, those who saw the divergence had weeks to act. Maybe less. Today, you have months. Perhaps less. The system is primed. The mechanism is engaged. The timeline is unfolding. The question is not whether it will happen. The mathematics of leverage and the precedent of history make the outcome clear. The question is whether you will be among those who recognize the pattern and act, or among those who dismiss it and pay the price. The divergence does not negotiate. It does not compromise. It resolves. And it resolves violently. The pattern has been triggered. The choice is yours.